Welcome to The Explainer. Today, we are diving headfirst into the electronic component sector for a huge 2025 financial showdown. We're putting four major players, that's CTS, Ralliant, Sensata, and VPG, right under the microscope. We're going to crack open their latest annual reports to really see who's built to last and who might be on shaky ground. So, here's the big question we're tackling today. In this crazy world of constant supply chain shocks and wild market shifts, which of these companies are actually built to last? You know, their 2025 annual reports are way more than just a bunch of numbers. They're like a crystal ball for the entire global manufacturing landscape, telling us who is truly thriving and who's just, well, trying to survive. First up, let's talk about the geopolitical stress test, because let's be honest, the whole game has changed. What used to be simple trade barriers have now turned into existential threats, and they're completely reshaping the electronic supply chain as we know it.
Really, it all boils down to three major pressures. First, you've got access to critical materials, where China's dominance in rare earths creates some serious dependencies. Second, there are the physical and logistical disruptions. Think about regional conflicts in places like Israel and Ukraine that can just halt production overnight. And third, there's this big strategic decoupling happening between major economies, which means costly tariffs and a massive expensive shift from global to more regional supply chains. These three forces are really putting every single company in this sector to the test.
So with that backdrop, let's dive into our contenders. We're going to see how each one of them weathered the 2025 storm, and we'll start with the company that seems to be facing the most heat.
All right, first in the hot seat, SensataTechnologies. And whoa, these numbers are pretty striking. We're talking about a massive $2.87 billion in total debt. But what's even more concerning is the interest coverage ratio. It's just 1.6. That means their operating income is only barely covering their interest payments. For a business like this, that is a razor-thin margin for error. It really ties their hands when it comes to investing in R&D or just surviving another economic shock. Frankly, it's a huge red flag for any investor.
So how is Sensata trying to manage all this geopolitical risk? Well, they've adopted what's called a China for China strategy. The idea is to create this self-sufficient bubble, where their operations in China serve the Chinese market. Using local currency, local supply chains, you get it. They're trying to build a firewall against US-China tensions. The thing is, this strategy has a major trade-off. While it might protect them from some risks, it also means they are incredibly concentrated and exposed to what happens in that one single market. And that leads us right to the verdict from HDIN Research. They've slapped Sensata with a high-risk warning, which you can see right here in Chinese. This combination of extreme debt and a very concentrated geopolitical strategy, well, it puts them in a pretty precarious spot. Okay, next up is Ralliant Corporation, and if there's one number that just screams 2025 for them, it's that $1.44 billion Goodwill impairment charge. That's a tough pill to swallow. It's also happening alongside a steep 17.3% decline in their test and measurement business in China. But it's not all bad news. They're still pouring a healthy 8% of sales into R&D, which tells you they're still focused on innovating for the future. So you see this term goodwill impairment, and you might be thinking, what on earth is that? Well, to put it simply, it's just accounting speak for when a company has to admit it overpaid for something. They bought another company, and now they have to say, you know what, that wasn't worth what we thought. In Ralliant's case, this massive write-down is a really painful signal. It suggests that all that initial hype around the EV market, which was a huge reason for their acquisitions, is being seriously reevaluated by the people in charge. And you can see the market's reaction right here on this chart. Ever since they split from their parent company, Fortive, Ralliant's stock has been trailing behind its benchmarks. It's pretty clear that investors are worried about this huge valuation reset and the weakness they're seeing in that key test and measurement part of their business. This brings us to how HDIN Research sees Ralliant. They've identified a valuation reshaping risk. The company is clearly in the middle of a major transition, and the market is basically trying to figure out what its new real valuation should be. It's a period of uncertainty for sure. Now let's switch gears completely and talk about Vishay Precision Group, or VPG. I mean, just look at this balance sheet. A tiny $20.6 million in total debt. That's almost nothing. They're a very focused niche player in high-precision foil sensors. But here's the twist. Their biggest strength is also their biggest vulnerability, a massive concentration of geopolitical risk. And the reason for that risk? Their main manufacturing base is in Israel. This 5-year stock chart really paints the picture of the volatility that creates. The company's performance, its stock price, It's all directly linked to geopolitical events in the Middle East. Any hint of regional instability, and boom, their operations are immediately at risk. This is why HDIN Research has labeled VPG a low-leverage defender. Basically, their financial house is in perfect order, which gives them a really strong defense. But that geographic exposure, that's a constant, unavoidable risk they have to live with every single day. And finally, we get to CTS Corporation, and wow, these numbers are seriously impressive. An interest coverage ratio of 22.6. That is incredibly strong. You combine that with an asset liability ratio of just under 28% and earnings per share growth of 21%, and you get a very clear picture of rock-solid financial health. So how do they pull this off? Well, it all comes down to a really smart strategic pivot. They made a deliberate choice to shift away from the more volatile transportation sector, which is now down to 43% of their business, and move into higher margin, more diversified markets like aerospace and defense. That's now 57% of their business. They're doubling down on these growth areas, and at the same time, they're rewarding shareholders with a big $100 million stock buyback. So it's really no surprise at all that HDIN Research calls CTS the stable benchmark. Their financial discipline and that strategic foresight really do set them apart from the pack. Okay, it's time for the final scorecard. Let's bring all 4 companies together for the showdown. Who actually won the 2025 stress test? This financial heat map tells the entire story in one glance. We've color-coded it to make it simple. Green means financial strength, red signals extreme risk. I mean, just look at the debt numbers. CTS and VPG are sitting pretty in the green. Then you look at Ralliant and especially Sensata, and things get deep into the yellow and red. And that interest coverage ratio, that's the knockout punch. CTS is at a super healthy 22.6 times, while Sensata is barely clinging on at 1.6. The contrast is just, it's night and day. So, after digging through all of this in their 2025 annual reports, here is the final verdict from HDIN Research. Here's how they rank our contenders, from the most stable all the way down to the most at risk. Coming in at number 1 is CTS Corporation, the stable benchmark, thanks to its clean balance sheet and that brilliant strategic pivot. In second place, we have VPG, the low-leverage defender, financially solid as a rock, but with that concentrated geopolitical risk. Third is Ralliant, let's call them the reshaping giant, working through a major valuation reset, but still holding on to core strengths. And that leaves Sensata in last place, the high-risk player, whose massive debt load just creates too much vulnerability. So the big takeaway here is that 2025 really exposed some deep vulnerabilities across this whole sector. And that leaves us with a really important question for the year ahead. As we see aerospace and defense growing and the initial hype around EVs cooling off, which of these strategic paths is going to define success in 2026? Is it going to be the company with the best financial discipline or the one with the most aggressive market strategy? Now, all of this analysis is based on the independent work of HDIN Research. And remember, this explainer is not financial advice. If you want to take a much deeper dive into the numbers and see the full breakdown of their methodology, you can download the complete report from HDIN Research. The link is right there on your screen. Thanks for joining us.